Hello, today I'll talk about one of the most important concepts of finance, that is deferring the tax liability. This is one of the most important concepts because it is how this is how companies usually manage the tax payable to the authorities using the leveraging the use of deferred tax liability. Deferred tax liability occurs due to the primary differences, temporary differences between how income and expenses are recognized under the financial reporting standards. Because the reporting standards provide this flexibility, so uh, companies leverages it to defer the tax asset or liability. So deferred tax liability represents future tax obligations. Since it is a liability, it is a obligation in the future. So how does it arise? It arises when book tax expense is is greater than cash paid, cash taxes paid. What does this mean? This means that when you record a higher tax expense in your financial statements, that when you record a higher tax expense in the financial statements than that what you are paying to the tax authorities now, so you are creating a tax liability. So you are recording higher taxes in the books, but you are paying lesser amount to the authorities, so you're essentially creating a liabilities. And uh, how this is actually done is we need to understand something about depreciation. There are two types of depreciation you need to understand. One is straight line depreciation, and another one is uh, accelerated depreciation. When you how deferred tax liability gets created is when you use straight line uh, depreciation for book purposes, and when you use accelerated depreciation for tax purposes, then that is how you create mm, a deferred tax liability. So to understand this, I will show you an example of how a straight line and accelerated depreciation will go hand in hand. So suppose we have an asset of, let's say, asset of rupees 1 lakh, and and let's say the income we are generating is for about 2 lakhs, and maybe the tax rate, let's say it is 30%. Mm. So for books we are doing what? We are doing straight line depreciation, and for tax purposes we are doing accelerated depreciation. So here when we let's say this asset has a salvage value, that is the life of asset is 2 years. Okay, so we need to depreciate this asset for over the period of 2 years, and for book purposes, let's say 1 year depreciation is about like 50,000 is 1 year depreciation. And for tax purposes, we are accelerating the depreciation. So for the first year, we say the depreciation is 70,000. And next year, since we are deferring the tax liability, it should be, let's say, 30,000. So, but all in all, the depreciation will be equal to the asset value. You need to understand this. So, the depreciation cannot be greater than the asset. So, we are doing 50-50 in a straight line depreciation. We are cutting down into equal parts, but accelerated depreciation will allow you to have higher amount of depreciation in the beginning, so that you will cut down on the taxes in the beginning years and create a deferred tax liability, so that you will be paying the taxes in at the later stages, but in the earlier stages you will use depreciation as a shield to avoid taxes. So this is mostly useful when you are building companies in the initial year. So the companies would not want to pay taxes in the early years, so they will use depreciation as a shield to protect themselves from taxes and keep the business running. So let me complete this calculation. So let one is books column and one is tax returns. So income is 2 lakh and tax return is 2 lakh. But we have depreciation. For books we are doing 50K, but for tax return it is 70K. So now the taxable income comes down to 1.5 lakh here and here 1.3 lakh. Since what I said is the tax rate is 30%, uh, the tax expense or tax payable is 30% of 1.5 lakh is 45K, and here it is 39,000. So we are arriving at a difference between the books uh, and what is the taxable income. Here the taxable income is less than books. So that is what I said here, that if book tax expense is greater than taxes, cash taxes paid. So how you pay less taxes? By using something called accelerated depreciation. Oh, so you are creating essentially a difference of 6,000 rupees in the year one. But this is a temporary difference. Why it is a temporary difference? Because the incomes and expenses are recognized uh, called, uh, are recognized differently. That is all that is happening here, but it has to equate in the end. So in year two, what you're doing is the income is, let me draw this column, books, tax return, income is 2 lakhs, taxable return is 2 lakhs. Now the depreciation is 50K for books, but for tax purposes, since he had 70,000 here, the accelerated depreciation for second year has to be 30,000. Pre-tax income comes to 1.5 lakh in the second year, and here it is 1.7 lakh. So the tax expense is 45,000, but here since 17, 30% of 7.7 is 51,000, and now we have created a difference of uh, minus 6,000. So always the difference between the books and for tax purposes has to tally, and that is how we are doing the reversal in the year. So this happens over a period of 5 years, 10 years, and I have given us very simple example so that the concept is very clear to you. So I hope I have made uh, deferred tax liability sufficiently clear to you. So the same way you can also create a deferred tax asset by uh, having book tax expense less than the cash taxes paid. So you are essentially prepaying all the taxes, and you are going to get the benefit of lower taxes in the future. So how is that will be done? That will be done by using accelerated depreciation for the books, and for tax return you are using straight line depreciation. So you are simply reversing the process that we did in this exercise. So I hope this concept is clear, and it is very fun concept and most very practical use case is there in this. So I hope uh, I made it clear through my presentation. Okay, thank you.